We also have the case of James Howells,
Yeah.
who had 8,000 Bitcoin disappear from a hard drive that he tried to recover, but it didn't really work out in the way that he wanted it to. Could Circuit actually prevent a case like this of happening, and how?
Yeah. So Circuit could have prevented it if it had been set up ahead of time.
Fair enough.
What James Howell did effectively, for people who don't have context, it's a famous case where a guy had his laptop thrown out, which contained the password or the ability to get into now $800 million worth of Bitcoin. And he's been fighting for years with the council in Wales to try and get access to the rubbish dump to allow him to gain access to his laptop to try and get the Bitcoin out. And it's become very widely publicized, and there's been all sorts of kind of interesting twists to it, like a hedge fund coming in and agreeing to take a stake in it. And now I think he's trying to release a token representing the claim on the assets themselves. But ultimately, there's now close to $1 billion, which was just thrown out in the rubbish, and no one can access it because the private keys have been lost. And more broadly, it's a massive problem that lots of people have faced. Lots of private keys have been lost. I think to date, people estimate around $350 billion of Bitcoin has been lost due to people losing access to the funds due to loss of private keys. And right now, there's nothing you can do about it. Effectively, once the private keys are gone, they're gone. You can't sign a transaction, you can't move the funds anywhere else, and they're inaccessible. And so what the Circuit does is we say, okay, what are the important things here? Is it the private keys, or is it the assets themselves? Ultimately, it's the assets themselves. You want to protect the assets. And so we focus on allowing you to always recover the assets without having to touch the private key. And the way we do that is by focusing on transaction layer security. We create, store, and manage pre-signed transactions. So think of these like pre-approved blockchain instructions that allow us to move the funds to a preset backup destination. So whenever you sign a transaction, you'll sign it and then it goes on chain and it's broadcast. Think about what we're doing is we're separating out those two parts. We're signing something, but it's not being broadcast. We're holding on to it to be able to use it at a later point in time. So in the case of James Howell, he would have set up Circuit ahead of time. We'd have created pre-signed transactions to enable him to move his funds to a backup wallet. And whenever he lost access to that wallet, he'd be able to move the funds to the backup wallet using Circuit, even though he'd lost the private key and lost access to the original wallet. And so this prevents that catastrophic event from happening, that even if you lose your private key, even if it's thrown out and the hard drive isn't available, you still have the ability to always move the funds out. And if you're an institution, it's effectively the same thing. It means even if your custodian goes down, or your wallet provider goes down, or you're not able to access your funds, you can still get those funds out. And so that's kind of a breakthrough ultimately, is you don't have to trust whoever is holding those funds without having the ability to move them yourself unilaterally. Because ultimately that's what blockchain was set up to do. It was don't trust others, self-custody yourself, but for a lot of institutions, it's not really possible. Ultimately, in certain cases, it's written into the rules of how they're set up that they need to custody with other third parties. But what we're enabling is you can actually both custody with third parties, but not totally rely on them. You still have the ability to get those funds out in the worst case scenarios where they go down. So we think it's both an innovation from a technology perspective, but also aligned with the ethos of the space, that it enables you to always remain in control of your funds, even if you give them to third parties to control and to protect.
Well, isn't that like I'm in the space for 8 years and I've been a retail trader. Right now we are an institutional trader. We have the fund, we have the venture capital. So custody is for us a very important topic, which if you look at it from the scope of being a Web3 degen, they all claim to be very much into the self-custody aspect. But society is not really built on self-custody at all. Like we all use banks, we all use entities for our services or our assets because we don't have the responsibility for self-custody at all. It's not being taught. And what now is being built is that you can use multiple people and then you have certain phrases of the seed or certain phrases of the private key to connect to the wallet. Which, in your opinion, is having a lot of vulnerabilities. Am I correct on that?
Are you talking about multi-signature wallets?
Yes.
So multi-signature wallets are better than just blindly holding a private key.
For sure.
But like anything, there's no one silver bullet. Multi-signature, if we take an example, there's 3 people, 2 out of the 3 people need to come together to sign a transaction. And then only when 2 of 3 people come together can the funds be moved. The issue is ultimately 2 people are still susceptible to colluding. So they can come together and say, actually, we're going to move it without the knowledge of the third person and take all those funds. Or they're vulnerable to being threatened. You could just find 2 different people and say, hey, we're going to hit you on the head with a wrench unless you sign it for us. So there's still always the ability to take funds out, even though you've distributed it. So it's definitely a step up from saying, hey, we're blindly holding the private key in raw form. We've now moved it to a multi-signature wallet. That's great. The next evolution from multi-signature wallets was MPC wallets, so multi-party computation. What they did is almost effectively similar to a multi-sig, but instead what they do is they use cryptography to almost effectively magic mathematics to chop the private key up into different bits so that even if the 3 were brought together or 2 were brought together, it doesn't give you any more information about the entire private key. But still, like anything, it's still vulnerable. If you lose access, you can't sign anything. If 2 of the 3 people lose access, you're still not going to be able to move the funds. And if someone steals credentials, so if someone is able to take the credentials that were able to sign it, they'd also be able to steal the funds. And so this is where Circuit steps in, is that even in that worst case where they lose access for any reason, you're still able to get those funds out. And the next product that we're building is that even if, and about to release pretty shortly, is that even if someone steals the credentials or steals a private key, we'll still be able to recover those funds in the majority of cases.
I'm going to ask some questions on that particularly because it's an interesting inverse way of thinking about security that we haven't been doing for a long time. But before that, you recently raised a 4.5 million seed round. First of all, how was it to raise in these current markets?
Yeah, we did. So very grateful to the investors who came on board. For this, it took place relatively quickly. So what we did is we set up conversations with lots of different investors. I'm very grateful and thankful to have lots of people who wanted to help and put us in touch with different people. So we had a lot of conversations over a relatively short period and found Nyka, who was our lead investor, who was a very good fit. So what Nyka do is that they invest generally in kind of fintech specific companies. And so a lot of Web 2 companies, but also Web 3 companies like Zero Hash, they've invested in Gemini, they've also invested in Revolut as well. And they're very focused on saying, how can we bridge these startups to the institutions, the major financial institutions in the US? And one of their theses is that digital assets is going to be adopted by institutions. And in order to do that, the security and the infrastructure needs to be put in place. And so they saw us as a very good fit for that. Ultimately, we're building critical infrastructure to enable institutions to enter, and it just aligned really, really well. And then once we had Nyka on board, it was possible for us to get several other funds and several other angels aligned along with them. And we ended up with a kind of fantastic round where we have 7 VCs total, Nyka being the lead one, as well as more than 20 different incredible angels from places like Citadel, JP Morgan, Galaxy, FalconX, Meta, and more. So really like a stacked group of people who are executives and decision makers and connectors and helpers who are seeing the value in what we're doing and try to help us win. So very, very grateful for that.
Well, it's impressive because nowadays the VC market, it's more focused on token VC rounds. They are quite bad at this point. The markets aren't in the best shape. So huge congrats for you of raising the seed round. My question is then, how is that going to accelerate the entire growth path of Circuit?
So it's already accelerated it enormously. What money allows you to do, mainly, is to hire really, really good people who are expensive at the end of the day.
Fair enough.
And we've been able to bring on some fantastic engineers. The latest engineer who's going to be joining us, he was previously he went to Cambridge, he did mathematics and physics at Cambridge, then he went to a major crypto exchange and built their internal custody division from the ground up, and was also involved in their high frequency trading and making that more latency sensitive. And he's going to join us next month because he just saw all the same problems that happened when he was building the crypto custody internally. And was like, okay, this is a massive problem that needs to be solved. Saw the depth and the smartness of the rest of the team, and is like, this is a great team to join. So we have really great group of people who've been brought together, and once you have a great group of people, it starts to kind of take a life of its own, and they're able to organize and self-organize and do their own things, and then attract more great people. So I'd say that really is our main use of funds, is to hire really great talent to enable us to get to the next step, both in the engineering side and both get in front of more and more people, as well as bring on incredible advisors who are helping ultimately upgrade and accelerate us as well. So main use of funds is just basically people, and that's helping us get to that next stage.
I mean, if you hire great people, they will hire great people themselves. It's a common thing.